Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of understanding credit spread risk in today's investment landscape. Investing can be complex, but understanding credit spread risk can make a huge difference in optimizing your portfolio. This risk, which refers to the difference in yield between different types of bonds, can significantly impact your investment returns. Not knowing how to manage and predict these spreads could lead to unexpected losses. For investors, recognizing and accounting for credit spread risk is crucial for making informed decisions. In this video, you'll learn what credit spread risk is, why it matters, and how to navigate it effectively to maximize your investment strategies. Let's dive into the essentials you need to keep your investments on track. Understanding credit spread risk. Credit spread risk is something every bond investor should understand. This section will break down the basics and the factors that influence this important aspect of investing. What is credit spread? The credit spread is the difference in yield between two bonds of similar maturity but different credit quality. It shows the extra yield investors demand for taking on additional credit risk. You can calculate it by subtracting the yield of a risk-free bond, like a U.S. Treasury, from the yield of a corporate bond. For example, if a corporate bond has a yield of 5% and a similar maturity Treasury bond has a yield of 2%, the credit spread is 3%. This spread is a key measure in assessing the credit risk of a bond issuer. The wider the spread, the higher the perceived risk. Why is this important? Because it can tell you about the market's view of the issuer's creditworthiness. When the spread is narrow, it suggests the market believes the issuer is less risky. On the other hand, a wider spread indicates higher risk. It's like the difference in interest rates between a mortgage borrower with excellent credit and one with poor credit. Factors influencing credit spread risk. Several factors can impact credit spreads. Let's dive into some of the most significant ones. Economic conditions. During a booming economy, credit spreads tend to narrow as investors feel more confident. In contrast, spreads widen during recessions because there's more fear of default. Interest rates. Changes in interest rates can also affect credit spreads. When interest rates are low, investors often seek higher yields in riskier investments, which can narrow spreads. When rates rise, they might flock back to safer assets, widening the spreads. Issuer creditworthiness. The financial health of the bond issuer plays a huge role. If a company's credit rating falls due to financial trouble, its credit spread will widen. On the flip side, if the company improves its financial standing, the spread will narrow. Market sentiment. Sometimes, investor sentiment drives changes. If investors suddenly become risk-averse, they will demand higher spreads even if there's no change in the issuer's creditworthiness. Understanding these factors can help you make informed decisions about bond investing. Knowing what drives credit spread risk can be crucial in assessing the potential risks and returns of different fixed-income investments. Impact of credit spread risk on investment strategies. Credit spread risk is a crucial factor to consider in any investment strategy. Understanding how it affects fixed-income investments and overall portfolio management can make a big difference in your returns and risk levels. Let's break it down. Fixed-income investments and credit spreads. Credit spreads refer to the difference in yield between a corporate bond and a comparable government bond. This spread can fluctuate based on market conditions, company performance, and broader economic factors. When credit spreads widen, it can often signal higher perceived risk. So, how does this impact your fixed-income investments? Bond prices. When credit spreads widen, bond prices usually decline. This happens because investors demand higher yields for taking on additional risk. If you hold a bond during this time, its market value will drop, affecting your overall returns. Yield changes. Narrowing credit spreads generally result in lower yields for new issues. This can be good for borrowers but not so favorable for investors looking for high returns. Risk assessment. Credit spread movements act like a barometer, indicating the market's comfort level with risk. Paying attention to these shifts can help you gauge the safety or danger of your fixed-income assets. Incorporating credit spread risk in portfolio management. Effectively managing credit spread risk can make your portfolio more resilient. Here are some strategies to consider. Diversification. Just like you wouldn't put all your eggs in one basket, you shouldn't focus solely on one type of bond. Diversify across various credit qualities, sectors, and maturities to cushion against spread widening in any one area. Credit analysis. Perform thorough credit analysis before investing. Look at the issuer's financial health, sector stability, and future earning potential. This can help you predict and mitigate potential credit spread risks. Active monitoring. Keep an eye on economic indicators, corporate earnings reports, and market sentiment. This allows you to react swiftly to changes in credit spreads. Use of derivatives. For more advanced strategies, consider credit default swaps, CDs, to hedge against credit risk. While this can be complex, it provides a direct way to manage spread risk. In conclusion, credit spread risk is a dynamic element that can deeply affect your investment strategies. By understanding its impact on fixed income investments and integrating sound management techniques, you can better navigate market uncertainties. Stay savvy and proactive to optimize your returns and minimize risk. Assessing credit spread risk. Understanding how to assess credit spread risk is crucial for investors. By using the right tools and evaluating real-world cases, you can make informed decisions. Let's break down the essentials. Tools and metrics for evaluating credit spread risk. To evaluate credit spread risk effectively, investors rely on several tools and metrics. These tools help in identifying and measuring the potential risks involved with credit spreads. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.